Welcome back folks to Investor Diaries. In this video, we'll speak about the differences between mutual funds and exchange traded funds, which are also known as ETFs. Today, both of these financial instruments are used by people to meet their financial objectives and goals.
So let's try to understand a little more about mutual funds. What is a mutual fund? A mutual fund is a type of investment vehicle consisting of a portfolio of stocks, bonds, and other securities. Mutual funds typically give small and individual investors access to a diversified and professionally managed portfolios at a lower price. These funds are divided into several kind of categories representing the kind of securities or the underlying securities that they invest in or the investment objectives and the type of returns that they seek. Mutual funds charge annual fees called expense ratios and in some cases commissions which can typically affect the overall returns that the funds achieve. The large majority of money in employment sponsored retirement plans typically go into mutual funds. There are different kinds of mutual funds catering to a specific niche or category like equity funds, fixed income funds, balanced funds, money market funds, and income funds, which, as we just talked about earlier, all caters to specific niche, specific objective, or a specific kind of return.
So let's try to understand some of the benefits associated with mutual funds. And the first one that comes to mind is liquidity. So as an example, Amazon today is trading close to 3,700 US dollars. So if you had to buy one stock of Amazon, you would need that much amount of money. That's not the case with mutual funds. You can start with as low as $50 or $100, and it is going to buy units in a mutual funds, which could be fractional. So it becomes pretty easy to buy mutual funds this way. Granted that Robinhood and some other trading companies allow you to buy fractional shares, but it is not so prevalent. Second is diversification. So being on that same theme of Amazon example, if you spend $3,600 to buy an Amazon stock, your entire investment is in Amazon today. However, if you had spent say $3,500 to buy a mutual funds, your portfolio would have consisted of a lot of different stocks, which means that it was much more diversified, which subsequently meant that the risks were lower, and if one of the companies didn't do well, you didn't have to worry about it because there would be other companies to take care of it. Third is minimal investment requirement. As we spoke earlier, you can start with $100 or $200, but the biggest advantage here is that you can set it up and forget about it. It means that similar to say your mortgage payments or your bill payments, here as well you can set it up with your bank, say $100 or $200 a paycheck. It keeps going out of your bank account and it keeps getting invested in it, and you don't even have to check your balance. You can check your balance when you feel like, but this will be an automatic process. Your money will be invested in mutual funds and you will see the returns in times to come. And finally, you've got a variety of offerings, which means that you've got lots of options to choose from. So you consider a big mutual fund company such as say BlackRock or Fidelity or even Vanguard, and you go there and you see the entire breadth of offerings that the company offers for mutual funds. A lot of these mutual funds are actively managed, which means that you don't have to worry about a particular company not doing so well. The portfolio managers managing that mutual funds will take care of that on your behalf. And that's why it's a very good financial instrument to consider while you are looking at your portfolio.
Now, there are certain downsides or cons to investing in mutual funds as well. The first one is high fees. Mutual funds typically have high fees, commissions, or other expenses associated to them, and that is a biggest downside to investing in this kind of instruments. The fees can typically vary from 1 to 3%, and that's every dollar that is not invested in your portfolio and that is not growing in your portfolio. That is a cost that comes out. The other downside is lack of transparency. So for example, you're investing in an S&P mutual fund. It's not that apparent or evident what are the underlying holdings in the mutual funds. Now, if you definitely do your research, if you go into the prospectus, you will there would be some disclosure about each holding and the kind of percentage into that, but it is not upfront and not very apparent, and especially to investors that are not very savvy. The next con is large cash presence in portfolios. So sometimes mutual funds typically have approximately like 1 to 5% of the asset under management as a cash position. Now this is typically done so that active managers have an opportunity to rotate in to certain holdings that they want either larger exposure to or certain new holdings. Now, as a retail investor, you do not have any say or control over when that cash is deployed for investment purposes. So that's kind of like a con when it comes to mutual funds.
Let's speak about exchange traded funds here, or commonly known as ETFs. Again, an exchange traded fund, it's very simple. It's a basket of stocks that trades on a particular exchange, such as New York Stock Exchange. Now, the difference to mutual funds here is that the exchange traded funds, its value fluctuates throughout the day, and you can buy and sell the exchange traded funds at whichever times of the day that you want to when the market is open. A big advantage of exchange traded funds would be fees. Like Nidish spoke about the high fees associated with mutual funds, that's typically not the case with exchange traded funds. And in fact, a lot of these ETFs are actually index funds. So they mimic the S&P 500 or the Nasdaq, or they have more thematic investments as well. But the expense ratios for some of these index funds are as low as 0.1%, which means that you are going to pay $10 over every $10,000 of investment. From a type of investment perspective, it gives you a huge range of opportunities. So you can invest in stocks, commodities. We've got ETFs for cryptocurrency as well. And you can also invest in international equities without really getting into the nuances as well, because there are lots and lots of ETFs in North America that contains holdings from Europe and Asia.
Now let's dive into what are the advantages of ETFs. The first one is access to stocks in across various industries. So similar to mutual funds, you get exposure to a diversified basket of stocks without actually having to invest in those stocks yourselves. The next advantage is, as Appy mentioned earlier, lower expense ratios compared to mutual funds and fewer broker commissions. Again, in ETFs, you have both active and passive ETFs as well. And the expense ratios for active are typically a little more higher than the passive ETFs. The next advantage is risk management through diversification. Now, again, as we described earlier, rather than you having to invest in each stock by yourself, by investing in ETF, you get exposure to a basket of stocks depending on the particular theme or the type of investment or the type of ETF. And that helps you in your risk management by diversifying your allocation. The last advantage is that ETF exists across a set of target industries. So these are what we like to call thematic investments. So like Appy mentioned earlier, you can invest in an S&P ETF, you can invest in a Nasdaq ETF, or you can even invest in crypto ETF. So if you want your portfolio to have exposure only to cryptocurrencies, you can just allocate your money to a crypto ETF that would provide you exposure to a diversified set of cryptocurrencies.
Cons of exchange traded funds. I think the bigger one would be there are some actively managed ETFs that have cropped up in recent years, and their fees is significantly higher than the ones we were speaking about for index funds such as Vanguard, which is as low as 0.06, 0.08%. There are ETFs which actually charge north of 1% as well, because they do actively manage ETFs. However, one thing to note is that it's still lower than what mutual funds actually charge. Second, it is important to realize that we should be careful in investing in ETFs as well, because a lot of these ETFs have thematic investments. So let's take the example of an ETF that mimics the price of Bitcoin. So if that's the case, then the ETF's price will go up or down according to where Bitcoin is headed towards. Or there could be an ETF that could be highly concentrated in a particular sector, such as banks. And as you might have seen, say some of these American banks, either they've gone up together or they've gone down together in the past year and a half. So the extent or the limit of diversification here is limited. So as you can see, ETFs, it's a great financial instrument, very low expense ratios. You don't have to think about the underlying mechanisms within the ETF, and it is sure to give you good returns in the long term.
So, our recommendation, if you're new to investing, our suggestion is that you can first start to dabble with mutual funds with low amounts, for example, even less than $500. This is suggested so you get a good understanding of the market. And once you have a fair understanding of the market, again, the time period is completely dependent on you. We would recommend from 3 to 9 months, but it's all dependent on you, on how comfortable you are with the market. But once you get that comfort or familiarity with the market, we would suggest you to start investing in ETFs and then start investing in shares as well. The other point to clarify here is that when you start investing in mutual funds, it's always recommended that you try to understand as much as possible about the fund that you're investing in, what is the kind of allocation that they have, what are the underlying securities that each of them hold, and what is the percentage allocation to each of these securities. Try to read as much as possible. We also recommend going through all our videos, trying to understand a little bit more about the market and how the market functions, reading other investment recommendation websites, etc., to understand a little more about the market, what are the factors that impact a share price or a sector, what brings it down, what makes it go up. That gives you a little more comfort. And once you have that comfort, we suggest you can start investing in ETFs and stocks as well.
I hope that this gave you good perspective. As always, feel free to like, comment, and subscribe to our channel, and we'll see you in the next video.
Thanks, everyone.